Depending on the performance of these specific 10-20 companies, you could be doing significantly better than the index or significantly worse than the index. Like you talked about, I carry an iPhone. This is made by Apple. I go home and watch Netflix, which is not listed here. I do most of my searching on the internet through Google. It's not to say that Indian companies are bad or something, because there are plenty of Indian businesses which have generated significant compounded returns, and they likely continue to do that. The other avenue, which unfortunately currently is not available today, is domestic mutual funds.
So coming back to investor, on a global context, today, there are platforms which allow you to go and buy, a stock directly in the US market. And what are the benefits and risks of having a concentrated portfolio versus a well-diversified invested portfolio or a managed portfolio? What do you think about that?
Well, it's the same whether it's in India or overseas. I think investors should work on the basis of asset allocation. Right? At the end of the day, you have certain financial goals in place. You need to build your portfolio so as to give yourself the best chance to achieve those financial goals. Right? It's not returns for the sake of returns. It is in line with your financial aspirations. Much like in India, you have an asset allocation across different asset classes with equities, fixed income, gold, real estate, and so on. Within equities, also, you tend to have allocation across value portfolios, quality portfolios, large cap funds, small cap funds. You also have global and India funds, right? You have geographic diversification as well. And like Hanny Markowitz said several years ago when he won the Nobel Prize, diversification is the only free lunch available. And diversification is simply not about buying more assets. You need to buy assets which have very low correlation with each other. The low correlation helps you to sleep peacefully at night, because when one asset is down, something else is up, and therefore your overall portfolio is at a reasonable shape. And secondly, if you're very disciplined and systematic about it, you can actually deliver superior risk-adjusted returns. When I say you can reduce volatility through diversification, people automatically assume that I'm reducing risk, therefore I'm reducing return as well. However, data shows that uncorrelated assets coupled with systematic rebalancing actually deliver significantly lower risk without compromising on your return. Right? With that asset allocation construct in mind, if you look at diversified versus concentrated, diversified portfolios replicate the underlying asset much more closely. Effectively, they deliver what is called as beta. Right? I'm choosing a certain asset class because I want to get returns pretty similar to what the underlying index or market does. So this is where diversified portfolios do a great job. In fact, I do recommend to my clients that much of your portfolio, the core part of your portfolio, should be diversified funds. If you can't select managers, invest in a diversified index fund. The concentrated portfolios, on the other hand, help in terms of low correlation. By their very definition, if you had 10-20 stocks in the portfolio, depending on the performance of these specific 10-20 companies, you could be doing significantly better than the index or significantly worse than the index, right? Therefore, what does it do? It adds a low correlated asset to your overall portfolio. And just as we discussed, diversification requires low correlated assets. There is a place for concentrated portfolios also. It may not be a core part of your portfolio, but it's clearly a satellite part of your portfolio, delivering diversification to the overall portfolio as well. Now, with concentrated portfolios, there is also potential to deliver alpha. Your diversified portfolio gives you beta. Concentrated portfolio potentially delivers alpha because it's not trying to mimic the underlying benchmark or index. So just like in India, globally as well, you can buy an S&P 500 ETF or a NASDAQ ETF, plus you can add 2 or 3 concentrated portfolios to to add that lack of correlation with the broader asset allocation.
Thanks, Pramod. So the follow-up question is basically, the greatest companies have come outside India only. If you look at last 30 years, 40 years, when you start a day, you start with a Unilever, and probably you want to start an office. You start with the Microsoft billing, from HP to everything. So you bill entirely to the global markets, right? So how should an investor integrate his international portfolio towards the Indian portfolio? And what are the benefits? And what do they lose? And what are the pros and cons of this, if you can briefly?
Yeah, I mean, look, I talked about diversification, and it so happens that India and US are not only the two best performing markets in the world, they have very low correlation. And to that extent, they make good constituents of a well-diversified portfolio. Having said that, I don't recommend people jumping into investing globally overnight. Most Indians have more than 99% of their assets invested in India. So that is a bit too much. I reckon, despite us having very strong views on the Indian market in the long run, it doesn't make sense to put all your eggs in one basket. Having decided to diversify, I mean, US is clearly the best market. Like you said, one of the other reasons is if you look at our own consumption baskets, it has very little to do with companies listed in India. Right? Like you talked about, I carry an iPhone. This is made by Apple. I go home and watch Netflix, which is not listed here. I do most of my searching on the internet through Google. I shop on Amazon. I take an aircraft to go back to India, most likely to Bombay. Most likely it's made by Boeing or Airbus. The aviation turbine fuel that fuels that aircraft is also imported. So to that extent, our own consumption baskets are not aligned with our invested portfolios. The point I'm trying to make is, at the end of the day, we are here to achieve our financial goals, and we are here to drive the best risk-adjusted returns in line with our financial goals. So therefore, why should we restrict ourselves to buying the best Indian companies when we can today buy the world's best companies, right? The world is our oyster, and therefore you need to expand our horizons. And that's the bigger benefit. Like you said, much of innovation has come through American companies, and we want to participate in the benefits of that innovations. Not to say that Indian companies are bad or something, because there are plenty of Indian businesses which have generated significant compounded returns, and they likely continue to do that. Diversification and the need to play global innovation is the way. Now, how can one do that? I think at the very least, anybody can open an account in Interactive Brokers or Vested, or talked about Ind Money, and start buying stocks. Now, I wouldn't recommend that unless and until you have the ability and the patience to do the research yourself. So I would, for those who can't find active fund managers, I would say buy a broad-based index. You can buy an S&P 500 ETF or a NASDAQ ETF on these accounts. The other avenue, which unfortunately currently is not available today, is domestic mutual funds, which used to feed into global funds. Because of the RBI cap of $7 billion, most of these funds cannot take your money. What the government has done in turn is opened up GIFT City as an avenue for ordinary Indians to invest in global funds. We've been one of the pioneers in that. We've had one of the first funds launched in GIFT City, investing in global stocks. Luckily, the first 3 years' performance has also been pretty strong. Having said that, I think the real problem we're trying to solve is the over-allocation of Indian investors to Indian equities. And the need for diversification means that more and more Indians will invest in global equities going forward. Much like we saw, even till 15 years ago, most Indians were largely investing in real estate and gold. Right? It's only in the last decade or so we've seen Indians becoming more comfortable with stocks, mutual funds. I reckon the next decade, more and more Indians will become comfortable with global investing, whether through stocks or through global funds like us. I think it'll become the norm for the future. And more importantly, a lot of Indians have global aspirations in terms of sending the kids abroad for higher education, right? These are liabilities built outside India. Why not have assets commensurate to those liabilities building outside India?
Exactly. Well said, one thing, when we sit with the client to do an assessment, today most of the kids are, have an aspiration. More than the kids, the parents have an aspiration for the kids to send to the abroad, right? Because yes, the standards what you get, the capability what they have built is definitely a world class. So making your kid to go to the world class institution is great, but have you planned for that? One of my clients, he was saying that he was with a 40% merit. Still, he had spent somewhere around 90 lakhs to a crore. Right? It's quite a huge money. And definitely, if someone would have planned it at least 10 years ahead of allocating some portion into international markets or a dollar-based asset, probably definitely it could have helped them in one part of the way. So,
Correct.
Very true point. And Pramod, you briefed us on markets, you briefed us on international investing, you briefed us on what are the caveats what an investor would have investing in a concentrated portfolio and choosing an index or an active fund, right? So now, probably we will get into the next part of the video where, now people to an extent they can understand, the means of diversification because it's a digital world, everything is available everywhere, right? But yes, there are a lot of misconceptions which are there, right? So which route to take, which format to invest, okay? So, because when I was diving deep, when I was speaking to one of my close friends, he was saying that there's an inheritance tax, more than $60,000 if you invest directly from India through an in-money or Grow or any platform or an interactive broker, probably you're going to have an inheritance tax. So these are the areas where there is a bit of gloomy structure. Probably if you can throw some light there, it'll be really great.
Yeah, so look, the inheritance tax is one specific issue applied to US-based equities. US has this law that should the unfortunate event of the demise of the shareholder happen, your next of kin will get the assets after deduction of certain taxes, which are inheritance tax. Like you said, up to $60,000, there's no inheritance tax, and then there is a slab rate which kicks in. At the highest slab, it can go up to almost 40%. And mind you, this is 40% of the capital, not 40% of the capital gains. So this can be quite punitive for a large investor. This applies to an investor who holds these shares on their own account. Like I said, one of the reasons not to own shares directly is if you're not able to do the research or tracking properly. The other reason is this. So therefore, if you are investing through a fund, you can eliminate inheritance tax risk significantly. The second thing to consider in global investing is the taxation differential, right? Because there are different capital gains tax rates applicable, unlike what we are used to in India. In India, on domestic equities, it's clear 12 months and below is short term, 12 months and above is long term. Short term capital gains tax is 20% for equities, and long term capital gains tax is 12.5%. Whereas if the stocks are listed outside India, the rule is, first of all, the definition of long term moves from 12 months to 24 months. Anything less than 24 months is short term capital gains tax. And mind you, the rate for short-term capital gains tax is as high as your marginal tax rate. So if you're in the top tax bracket, you're mostly headed somewhere close to 40%, which can be quite punitive. The long-term now has been aligned to domestic, 24 months and above. The long-term capital gains tax is 12.5%. We have a master feeder structure in Gift City and Cayman, where through a 25-month lock-in, which prevents anybody from redeeming in the short-term window, we've eliminated short-term capital gains tax incidents, and therefore we provide a very tax-efficient structure through just long-term rate of 12.5%, which is pretty much similar to a domestic mutual fund. In an AIF, the tax is at the fund level, and therefore what the client gets is post-tax NAV, and they don't have to pay any taxes from their end. These are two big differences which one needs to consider while investing globally as opposed to domestically.
Okay. So Pramod, as you were briefing about your product, it's again a first of its kind product where, it feeds into the Cayman Island and very tax efficient structure as on date in the market, right? So if you, before getting into your offering and getting into the product structures, if you can throw some light around the LRS route, because most of them doesn't know the route, how the money, it's not like a mutual fund buying, right? So first we have to open a zero-based folio, and then you have to remit the money as a overseas money. So there is a LRS limitation. If you can throw us a bit more light on that, how it goes, it'll help our viewers.
Well, that's a great question. India has been a capital constrained economy historically, and therefore the RBI and the government have put capital controls. So it's not easy to send money outside for investment purpose or for any other purpose. The government has introduced a scheme called the Liberalized Remittance Scheme, under which a PAN holder can send up to $250,000 per annum overseas, right? So to that extent, it's not as simple a mechanism, much like how we buy mutual funds today. For that matter, even a PMS investment can be done through a simple RTGS or an NEFT transfer. It's a little more cumbersome, but although increasingly it's becoming simpler and simpler. So for example, in our fund in Gift City, there's a fund's bank account to which the client, after opening the account, needs to make the remittance. The remittance often will involve filling up a form with your bank, because it involves conversion from rupees to dollars, and that is remitted as dollars into the fund's bank account. Some banks have begun to allow digital payment as well, up to a certain amount, say $50,000. However, that might involve some rack rates on the forex. If you are a high net worth individual, you'll get better exchange rates if you can negotiate offline with your bank. But once you made that investment, it becomes pretty much like any other investment. In fact, the government has allowed Indian banks to open dollar bank accounts out of Gift City, so that you don't have to convert from dollar to rupees, rupees to dollar every time you redeem an investment. You redeem our fund, your money stays in Gift City in dollars before you make the next investment. So there have been a lot of reforms that are happening which are allowing Indians to invest in global assets through Gift City with very, very simple terms.
Got it, Pramod. So I think you briefed on LRS and, yes, when people started, tracking mutual funds 10 years back, it was like a very tough investment. We have to do a KYC and other things, right? So I think we'll get used to this, and it's a new process. It's not about a very tedious thing, is what I feel. So next part, probably Pramod, you spoke about the opportunity which are there, and the relevance of investing into global markets. So coming from Marcellus, so what is the structure you have created, okay, for the as an offering to the investors? And if you could brief a bit more on Marcellus global compounder investment philosophy, it'll be really great for us to understand about the product.
Right. Well, the structure is simple. Like I said, we have a master feeder structure. There's a master fund in Cayman, which buys the stocks in our portfolio, which holds the stocks in the portfolio. And there's a feeder fund in Gift City, which is a category 3 AIF, which buys the units of the master fund in Cayman. Resident Indians will invest into the Gift City fund, and they'll have units of the Gift City fund. We have a 25-month lock-in, like I said, to eliminate any short-term redemptions. As it is important and sensible to invest into equities with a long term in mind, but also it makes it a little more tax efficient. That's the structure. As far as the investment philosophy is concerned, we invest largely in developed markets, which is largely North America and Western Europe. US, Canada, and Western Europe make up bulk of the portfolio. The only exception to this, we own a stock in Taiwan called TSMC, which is the largest semiconductor foundry in the world, whose market is truly global. So from that perspective, we consider it as a global company as well. The philosophy is very identical to Marcellus's overall philosophy. We believe in quality investing. First and foremost criteria is we should have confidence in management integrity. Because at the end of the day, they are custodians of our clients' money who become shareholders. To that extent, that shareholder interest should be protected. So we use a proprietary forensic accounting model to assess management integrity, because accounting quality is a very good proxy for management integrity. Then we look at the last 10, 20 years of financials to assess how the business has behaved in various parts of the economic cycle. Because at the end of the day, we can't predict the future of the economy. Economies, by definition, go through cycles. If you can't time those cycles, we need to be comfortable investing in companies which come out strongly even through a downturn, which have weathered multiple cycles in the past, and hence reasonable probability they'll face this as well. So we look at long periods of history in terms of consistency of ROCs, which are return on capital, is the best measure of profitability, consistency in free cash flow growth, and so on. That gives us a list of about 100 stocks. We start with about 1,200 stocks listed in the US, Canada, and Western Europe. Using quantitative filters for integrity and quality of the business, we come to 100. These 100 stocks are then subject to bottom-up research, because what we know so far is it's run by clean management teams. It has had a great history, but at the end of the day, we are investing for the future. What we are trying to assess through the bottom-up research is what is it that made this company deliver that consistently strong historical financials, and whether those factors will sustain into the future, so that even the future financial track record is strong, and hence likely stock price returns are strong. So the first process of the bottom-up research involves going through last 10, 20 years of annual reports and earnings transcripts. And a large part of what we do in this process is primary research, where we do independent third-party checks, where we speak to customers of the company, suppliers to the company, former employees, competitors, to get a much richer picture of the company in terms of existence of moats, capital allocation mechanisms, succession planning, and so on, which in turn informs us about what could be the potential intrinsic value of this business. And then finally, we compare the intrinsic value to the price. If there's enough margin of safety between the two, it comes into the portfolio. We tend to manage about 25 to 35 stocks. By and large, the philosophy is about reducing risk, right? Quality is all about reducing risk. Moats are all about reducing competitive risk. Similarly, we focused on a couple of themes which reduces risk. A big part of the theme is what we call as pick and shovel, right? This terminology arises from the Californian gold rush of the early 19th century, when gold deposits were found in California, and suddenly there was a rush of all mining companies. Because there were so many mining companies, very few actually found enough deposits, and to find that little deposit, they had to spend a lot of money digging through. Eventually, none of the miners made money. The ones who actually made money were the guys who were selling the digging equipment to these miners, which are picks and shovels. We apply the same in today's scenario. For example, airline traffic growth has been pretty strong and consistent over long periods of time. Yet, airlines have been notorious to have destroyed shareholder value. Very few airlines actually make money or deliver shareholder returns. However, there are these companies which make spare parts for aircrafts. Two of them we own in our portfolio are Heiko and TransDigm. It doesn't matter whether it's a Boeing or an Airbus. It doesn't matter whether it's Indigo or Air India in India, or Southwest Airlines or United Airlines. These spare part manufacturers dominate that particular spare part. They've had long track record of 20-25% free cash flow compounding over 20 plus years. That is a classic example of a pick and shovel. I'm not betting on a Boeing or an Airbus or a Indigo or an Air India. I'm buying what we call as neutral arms dealers or pick and shovel strategy. That's a consistent theme in our portfolio. The other way to play it is through utilities, right? When we talk about utilities, we're looking at electricity providers, water supply providers, railroads, and so on. But the biggest modern utility is the data center, right? Most of us operate our data on the cloud. The biggest cloud companies charge us a bill on a monthly basis, and we consume that. So this is a constant theme in our portfolio, which aligns to our philosophy of delivering superior risk-adjusted returns over long periods of time.
So, thanks, Pramod. You've briefed and demystified your structure.
How can you do global investing sitting in India? One of the companies in our portfolio is called IDEX, S&P 10 and S&P 490. The stock goes up, its market cap goes up, therefore its weight in the S&P 500 goes up.